All right, so we are here with mortgage expert Josh Dobson. We're going to talk a little bit about the housing market, macroeconomics. We'll go over all the data, make sure everything's running smoothly. Is it working? Is the lives working? I think we are working here. Good. We got everything Instagram, TikTok. All right, Josh Dobson. Josh, what is it's been a while, man. How you doing?
Yeah, man, I've been good, man. How about you?
I'm good. I'm better. I'm not sick anymore. Holidays over.
You were getting sick a lot, bro.
Dude, I'd never get sick. Last time I got sick was literally I had COVID. So I'm like, bruh, what is this?
Yeah, you got
Um,
to be careful when you start saying that stuff.
you do. Oh, that's right.
It
Golly, I can't
dares
say
you.
that. Okay, don't listen to that TikTok because you might take it the wrong way. All right, got suspended too for probably talking about politics. Anyways, what is the state? What would you say? What is the state of the housing market? You're in it every single day. Let's give us a breakdown of what's going on.
So a lot of what we were talking about last year, how as rates start to come down, we're going to see more inventory, we're going to see more demand, and we're going to see an uptick in applications. All of those are coming to fruition. So since I got back from vacation and the new year started, we've seen a huge uptick in requests for home equity lines of credit and refinances. We've seen a huge uptick in clients reaching out to get pre-approved to buy houses. I would say several of my past clients have decided to list their properties so that they can move where they want to move and buy the house that they want to buy. So we're seeing inventory numbers start to go up a little bit. We're seeing demand pick up, and we're seeing a lot of clients reaching out for the refinances. And that's all just because rates have dropped down into the sixes. It'll be a firestorm when rates get down into the fives because that's where they're headed.
Okay, and that's funny. You covered some of the questions I was going to ask. How is the
Sorry, bro.
demand and supply? So let's just go over let's go a little more in depth. See, that's the breakdown you get there. So it sounds like demand is picking up already.
Yep, it
Demand is
is.
picking up. And at the same time, supply is picking up.
Yep. And that's
Okay.
kind of what we talked about, right? So
Right.
as rates start to come down, you're going to see more people who were sitting on the sidelines about selling their houses because they bought prior to COVID or during COVID, have the ridiculously low rates. They were like, you know what? We didn't buy this house as our forever home. We wanted to be able to move up. But as rates hit the 8% range, they were like, this is not the time to be trying to sell and buy a house. But as rates start to come back down and more normalized, you're seeing more of those clients like look at it going, hey, you know what? I think this might be a good chance for us. I think rates aren't going to get much, or they're going to get a little bit lower, but they're not going to get much lower. So we really need to take a look at and see what we can afford, what it's going to do to us, how we can make this work, because we don't want to get stuck. I mean, so the golden handcuffs are starting to come off for a lot of people. We're going to see a lot more of that coming as rates drop. But as that happens, again, they're sellers and that increases inventory, but they're also increasing demand because they are now buyers as well. So you're seeing sellers become buyers, and those people who missed the last window are getting more focused and getting a little bit more aggressive and looking to buy a house. So you're going to see the demand that's been pent up this whole time really pick up and really start getting active in the home buying process. So yes, you're adding inventory, but you also have more demand. So really, the story is going to be, like I said, um, the only thing that's going to really cause a downtick in home prices is going to be an influx in inventory, and that has to come from either short sales foreclosures or builders building more single family homes faster than they've been building them. But we're not seeing that either.
Okay. Wow, okay, great breakdown there. And I had a question too, because I'm not too familiar with it. Why are people like wouldn't people just wait for 5%? Why do you think, or from your experience, why do some people want to move if they know they're gonna pay a little higher rates than they're already locked in at 3.5 or whatever? What is getting them? Do they believe they'll never be able to move again? Is that what it is? They don't think they'll be able to move again. This is low as rates go. What's motivating them to actually move? Because from my perspective, I'm like, hey, aren't you taking a loss if you move? Can you break that down?
So what you're seeing is people who really wanted to move over the last 6 months. So that's that pent up demand. They were sitting on the sidelines because of rates being as high as they were. But as rates have come down, 2%, they're looking at it as an opportunity. Looking, hey, you know what? I can afford this. I really don't want to live in this home much longer. I want to move up or I want to move down. I want to do something other than live here for the next, 30 years. So it's more of a mental thing. I think a lot of the demand in the housing market is centered around interest rates. And I think so a lot of people aren't hyper focused on, so a percentage of the people aren't hyper focused on the 5% range. They're just more focused on the affordability. So as rates dropped into the 6% range, affordability increased. I think there's a good friend of mine, Min Win. He does a good job of breaking down home affordability as far as rates versus incomes. So there's a larger percentage of people who can afford to own or buy a house as rates come down, and that's just the simple math of it, right? So in the 8% range, I think it was something like less than 10% of the U.S. households could afford to buy a house at that point. But it almost triples as you drop into the 6% range. And I think it's closer to like 65 or 70% once you get down into the 5% range. So what you're seeing is just more of the people who now look at it as affordability and they can afford it, um, jumping into the market.
Okay, so it sounds kind of like economic, and I wanted to ask you, it sounds like economic momentum is sort of picking up in the housing market. Do you think, let me throw this chart up real quick to just kind of give a visual. I wanted to ask you, where do you think we are in the housing market? Where are we at in the cycle? You have expansion, contraction, recession, economic recovery. Where would you say we're at based off the data you're seeing come in?
We're kind of in an in between phase. We're not seeing it accelerate too much. It's more of a flat line. I think I did a video on it yesterday. We talked about how we're going to see home prices flatline or stay pretty flat for 2024. So we're not going to see an acceleration in price growth, but we will see it stabilize. So yeah, we did see some price cuts towards the end of 2023 because of those sellers who had to sell. But that's going to be fewer and far between. There are going to be some markets that are going to see a decrease in home prices and values, and that's just because those are some of the areas that got overbuilt as builders focused on areas to build in. But for the most part, as inventory and demand both grow together, they're kind of going to just kind of wash each other out. So we're not going to see huge price increases. We're not going to see price dips again unless something major happens. So I think what you'll see is home prices flatline and a more normal market in the sense that it's going to be buyers and sellers all getting into the market and enjoying the little bit lower interest rates.
It sounds a lot like the stock market. Correct me if I'm wrong. I call this a stock pickers market. Some companies are not positioned well. Other companies are positioned to, the rates aren't even going to bother them. The slowdown doesn't matter because in their area, it's accelerating. So I'm guessing regionally or state by state, we're looking at a housing pickers market, correct?
Yeah, definitely.
Okay. San Francisco is getting crushed finally, I believe, right? Way too
Yeah.
much build. Um, I think Miami hasn't fallen at all. Miami's still climbing, right? I heard somebody say that oh, you know what? He's a billionaire, some billionaire dude. What's his name? He has a hedge fund. He's moving it from Chicago to Miami, and he's saying Miami will become the financial capital of the world, is what they're saying. And I guess people are moving over there to Miami to get that traditional, maybe more of a traditional sense,
Got to be careful what you say there, huh?
You do. You got to try. Yeah. So yeah, I found that interesting. Now, um, yeah. So you explain that. Now, do you think, because we're talking about prices? A lot of people, if you guys have questions, don't hesitate about the housing market right now. I felt like on the last Fed meeting, because the Fed pretty much just switched, right? They went from higher for longer,
We're
and
yeah,
they're
we're not going to touch rates for a year. Yeah.
right, and you hit me up about that. You're like, "Wow, big flip, right? Big flip." How do you? What is your view on that change? I know what my view is. What is your view on that change? And then I'll tell you kind of what I think they're trying to do. I want to see what you think first before I throw it out there. What do you think the Fed's trying to do? What are they focused on? And what do you think they're trying to do by flipping so quickly from no hikes? I'm sorry, no cuts in 2024 to now 3 in the SEP.
Yeah, no, so obviously they're trying to backtrack since they said that. We've even heard that they aren't looking to do any rate cuts towards the end of 2024 now. So they're trying to push back that a little bit. the exuberance after they said that, really rallied the market, rallied, everything. So I think they've been trying to backtrack just a little bit. But again, we talked about this, right? It is all a mental thing. So whatever they say affects the market. And I think the Fed's a little bit concerned that what they did with interest rates was going to put a real damper on the economy. So instead of staying more hawkish, they're going a little bit more dovish to try to soften that whole soft landing versus hard landing. And I think they're positioning themselves again because they have to be trustworthy, right? So they said no cuts in 2024, and then they had to switch to, hey, we're going to do 3 cuts because they've got to be transparent. Because otherwise, anything that shocks the market can really have a negative impact on it. So I think what they're doing is they're realizing, hey, we need to soften this a little bit. We need to be prepared to do some sort of rate cuts if we see the economic downturn that we kind of see happening as we move along into this with higher rates, the cost of everything. So I think it was more of just preparing and softening the blow and giving the proper expectations, knowing that they may have to do rate cuts to help.
I agree. I think we're headed down a path of really fast deceleration. It's almost like the Fed is speaking to both the bond market to lower RTE's conditions or whatever. They're speaking to the bond market, and also it sounds like they're speaking to these supply chain managers, like, "Hey, stop ordering so much." Now they're like, "Okay, wait a minute, we're falling too fast. Let's go ahead and we're going to cut rates." So what I think they're doing, when it comes to the housing market, are you still there? Can you hear me? I'm not sure if you can hear me, kind of cut out. Yeah, can you hear me now?
Yeah. Sorry.
No, you're good. So I know every time you get a call that it shuts off or something like that.
I
Yeah.
gotta I gotta put it on do not disturb.
Yeah. So what I think the Fed is doing right now is, okay, we couldn't get housing prices to decelerate by increasing rates. It didn't happen, right? Everybody's locked in at 3.5%. Nobody sold. Housing prices are still climbing in the macro. So you know what? Let's go ahead and flip the script and say not cut rates, but let's just say, hey, we're looking to actually cut. And I think every economist now is like, okay, we're not seeing a recession, but we do need in order to get those housing prices down, we need to accelerate supply. We need to get that supply back up for the housing market. Maybe that won't cut prices or lower prices, but it'll at least decelerate the price increases. So I think that's what they're trying to do is as soon as we saw that, he flipped the script. All of a sudden, they're using their tools, right? Using their communication tools. People, that's hard because there's no, how do I say this? There's no curriculum for that.
Yeah,
Nobody
there's no
teach.
playbook.
There's no playbook. There you go. There's no playbook for that. So you kind of have to just, follow it along and try to learn and adapt to it. And I know I'm speaking kind of slow here. There's so many thoughts in my head, but I'm trying to make it simple too for the new audience. So anyways, what do we see? Home builder sentiment jumped, I believe.
Yep.
And then you saw
So
the
again, that's simply rates, right? A
right.
lot of builders were very negative about building and being in that market because of where rates were. They just saw a huge dip in demand. They were having to give out tons of incentives just to sell the homes that they were already building. So with that gives them a little bit more incentive to go and build. And I think that's where the Fed may have missed the memo. We have a housing shortage. Regardless of what anybody says, we have a housing shortage. And that housing shortage is only going to be filled up with more homes. Because after the 2008 crash, there was a good 10 years there where builders weren't building anything. And so
Mhm.
as the population grew, we saw Gen Zers come of age and be considered, the family building age group. They needed housing. And it wasn't just buying homes, it was renting homes. There was just not enough housing for people to be able to afford, whether it was rent or buy. So they've got to encourage builders to build. They've got to encourage investors to invest in real estate so that they can have landlords who are renting homes as well for those who can't qualify or afford to buy a house.
Mhm.
But then they also need to add more inventory for people to be able to buy homes. So
Right.
I think that's kind of where they missed that memo as far as the housing shortage. I think they assumed that we didn't have it, or at least that they could get away with slowing the economy down, or at least the housing economy down by raising rates. But what they failed to realize is that there was just a lack of inventory. So as people who bought with 3% interest rates, got their golden handcuffs, they decided, hey, look, we're not selling our house. That just decreased inventory even more. And then they deterred builders from building homes because of interest rates and what the incentives they had to give just to get people into the homes that they were already building. So I think this is kind of just, it goes hand in hand with all of that.
Right. Very complex picture there. We have a comment from TikTok dealer. His name is Dealer with the two E's, or maybe it's Dealer. T Jefferson. T Jefferson told you. I have no clue who T Jefferson is. You know who that is?
Thomas
Uh
Jefferson?
oh, maybe that's what he meant. First by inflation, then by deflation, they will take your property.
Gotcha.
Um, I mean, sure. If you're smart, maybe not, but okay. I hear you, T Dell. You got any comments on that, Josh?
Yeah,
You're
I mean, obviously, inflation and deflation are all working against the average person. So if that's their end all goal, I mean, that's a huge conspiracy theory, right?
right.
If that's their end all goal is to take everybody's property and you'll own nothing and be happy, then yeah, I mean, that is their goal. They're going to cause inflation, then they're going to cause deflation. But at the end of the day, both of those things hurt businesses as well. So where does the line get crossed, and how do they make that happen? I mean, that's the big question.
Jessica Pennington says, I believe the government is forcing private equity to sell off their single family homes.
So there are there's, I mean, there's so many statewide bills, national bills talking about getting foreign investors out of real estate in the United States, getting corporations out of real estate in the United States. Um, eh, that's counter to what a dealer was saying, right? If we're going to own nothing, corporations are going to have to buy up all the single family homes. So does the government really enforce or put something in place to prevent corporations from buying or owning real estate? I highly doubt it. One of the things that I've noticed, there's a lot of talk about how corporations are pushing the average Joe out of becoming a homeowner because they're buying up all the single family homes. It's a fraction. It's a small percentage of the single family homes that corporations actually own. Who's really buying up the single family homes are your mom and pops. It's your investors like me and some of the other people who own real estate. They own a majority of the single family homes and are renting them out. It's not big corporations. Obviously, I mean, it's only been within the last probably 7 or 8 years that this has become a phenomenon that corporations were buying real estate, single family homes to rent them out. But they don't own a huge percentage of it. And obviously they've got shareholders to answer to. So those private equity firms have to be careful if they're buying up real estate in a downturn market and they're losing money. So I think it all goes hand in hand. It's going to take a lot of corporations and a lot of private equity firms to buy up real estate to gain shares in the actual real estate market. But if that again is the conspiracy theory that they're going to do that, then that's what they're going to do, unless our politicians step up and listen to the people and say, "Hey, look, you need to keep them out of it." But I don't think that's a great economic, economy to really push as far as policy is concerned, because it's economics, right? Supply and
Right.
demand.
Shout
They
out
are
to you.
a
Oh, go
portion of the demand, right? And
right.
it's important that we have them because they're buying the real estate that needs to be bought to keep home prices level or keep it up.
Right.
Without them, we could have seen a huge crash. So again, it's kind of free markets, right? That's what we want. We want capitalism to
We
work.
do.
And anytime you get policy involved, we've learned that government policy has done a pretty terrible job of making sure we're all right and that the economy's all right. So maybe it's better that the politicians stay out of free markets.
Right. I agree 100%. A lot of people I know they get pissed at the government, but it's like, hey, you gotta weigh it out. Graham Stephan, he's a famous YouTuber. He
Yeah,
talked
yeah,
about he did a investigation on this, and he's like, actually, BlackRock and all these big institutions are only 3% of the supply.
yeah,
So it's kind of people swing from one extreme to the other when really it's just inflation is taking over basically. So people think, oh, they're buying up all the homes. Well, the baby boomers, they got like 60, 70 trillion dollars. That's where all the money's at. It's in the baby boomers. So just stay patient. I say,
yeah,
don't fall
definitely.
into water.
Yeah.
Right. Okay. Any other questions? Shout out to you, Dimaj. Appreciate the support there, Dimaj. Diller says home prices will have dropped and banks will take the property. Same thing happened in 2008. Um, well, go ahead. I'll let you take that. Home prices will have dropped. So I think he's saying home prices are going to drop significantly. Banks will take the properties. Same thing in 2008.
Yeah. So again, the only way home prices drop is if we see a flood of inventory. The only way
Right.
say we see a flood of inventory is if people start losing their jobs and they can't afford their mortgages. But we're talking about people who have mortgage payments that are less than what they can rent for right now, less than what they can buy for right now. So there's actually some data on this, right? We've seen an uptick in credit card delinquency and car loan delinquency, but we've seen mortgage delinquency at its lowest in history. And the reason being is that people are desperately holding on to those mortgage payments because they are so low. And I think that's where you're not going to see a repeat of 2008. And you got to understand something. Banks don't want to foreclose on properties. They really don't. And here's why: it costs them more to foreclose on a property and either resell it or sell it than they actually make any sort of profit. Even with all of the equity that are in these homes, if they were to go through a flood like they did before, home prices would drop significantly. They would actually be shelling out money to be able to foreclose on those homes and then resell them. That's what happened in 2008. Banks really don't want to foreclose on homes. That's the reason why lenders are painstakingly investigating and making sure that the people that are buying homes and getting mortgages can qualify for those mortgages, because the banks don't want to repeat of 2008, because it hurt their bottom line. Whether you believe that or not, you can look at their holdings and what they went through in 2008, and they were losing more money than they were making when they were foreclosing on those homes and then having to sell them as REOs.
Okay. There you go. There's your answer.
Yeah,
Uh,
there's no economics in foreclosing on a home. It is
no.
all pretty much a loss.
Right. So you need that. We basically need that supply there to keep coming in. So whoever's going to build, you need to incentivize the market. There, government people complain about government, but then they want government to make a change the market. But you got to let people are going to lose. There's going to be losers and winners no matter what, and that's how life goes. You adapt to it. There's no soft pillow for everybody's situation. Unfortunately, that's just how the reality works. Now, I thought this was interesting. I'm going to ask you about this. Ironically, right? We talk about, I don't know if we could say this. I'm going to say it a little bit. Closed borders, there's that whole argument. But come to find out, the Fed talked about this in the last meeting, that immigration was much stronger than he thought it would be. And that actually helped to supply more labor, and which actually helped with inflation, right? You have more supply of labor. You probably
Brings
can low.
brings wages
Yeah,
down. Yep.
brings wages down.
Cost of
And
goods, all that stuff.
right, ironically, that helped the economy. And a lot of people, a lot of my family members were upset about that. And I'm like, well, that is the reality. There is no you upset that the fact that, well, the border stuff, it's like, it is what it is. You want higher prices, or do you want your political views to come into place, right? We'll see how that plays out. Now, this was interesting. Construction industry job openings. So even though we are decelerating in the services economy, or we've been in a recession, construction, manufacturing, all the way to the right, from this time last year, we've added 111,000 jobs. And these are all construction. They were talking about it today.
Yep.
They're trying to get high schoolers to come in. We need more labor
Yep.
supply, and a lot of that is in the manufacturing and services sector. And so, regardless, we need more people, right? Wherever they
Yeah.
come from, we need more people. And most people who are coming, they're coming to work, right? Because I watched a documentary since when I was sick, and I'm looking at all these other countries, right? The people leaving, and they're starving to death, right?
Yeah.
There's a
Yeah.
lot, right? And I'm not exiting all the other stuff, like saying, oh, well, there's no, criminals and all that, but most people are not coming to do that. They're coming to America is the land of the free. So
Yeah.
we got to get a better, obviously we got to do better at how we do that process. But at the end of the day, a lot of people, not want to say my age, but younger, they're not working. They don't want to work. They want to, they're not contributing.
Yeah. No, and
So
I mean, I think we've talked about it before, right? The demographics of a population are very important. You look at China; they're more elderly than they are young because of they didn't have enough children. And
Right.
unfortunately, in the United States, we've seen a trend towards more of the younger generations as they come up to start families. They're not having children because it's too expensive or they just aren't ready. You have fewer and fewer people having more and more children. So as our population growth doesn't accelerate like it should to help with the demand for jobs and labor, there's got to be a place for the country itself to bring in that labor force. And so those open borders have brought in the labor force that we weren't supplying with the family creation and having children. And that's actually been a good thing for the economy and it should help with prices. But again, you got to realize, right? So we talk about policies and how it affects the economy. I think, was it Pizza Hut just laid off thousands of pizza delivery drivers here in California because the minimum wage for pizza delivery drivers was $20 an hour or $21 an hour. And everybody's up in an uproar over it. And it's like, well, when policy steps in and tries to raise wages that shouldn't be raised, because
Mhm.
again, it's free market, you're going to pay somebody what it's worth to have them there. And you look at what their profit margins are on delivering those pizzas, raising it from 15 to $20, you just probably pretty much lost all of your profit on every pizza you deliver. So Pizza Hut had to make a decision. Look, we're not going to pay for $21 an hour for a pizza delivery driver. We're going to have to outsource those deliveries, or maybe we just stop deliveries altogether. But that's where policies from politicians start to muddy the waters in free markets. And I get it, right? We need to raise wages because people need to be able to afford to live, but raising minimum wage isn't necessarily the answer for that. It comes down to the population itself and its willingness and ability to put itself out there and become, worth more as far as their wages. And I think that's where we're seeing a lot of the problems happening with some of these policies and wage growth and inflation. We want politicians to save us when we should be saving ourselves in this respect.
Right. Meritocracy. I always say meritocracy. You want an economy works best when people are producing enough or they're getting paid according to what they bring to the table, not so much
Yep.
because they exist, because they entered the market. That's never been the case in history. So, again, this is a principle here, and a lot of people are not versed on this, but a principle is, well, the more you raise wages, the more that these companies they have to cut employment. So I always say, what do you want, higher wages or do you want a job?
Yep.
Right. So where do they go? Black market, where do they go, right? So, and it's obviously if wages were low forever and it's like, the economy is expanding really, extensively, then you might be able to raise wages a little bit. But in California or whatever, I mean, come on, Pizza Hut, goodness, that's how much they were paying teachers with a 4 or 5 year education,
Yep.
just about 4 years, 5 years ago. Now it's
Yeah.
boom, right?
Yeah.
And what are they producing? Pizzas? You can automate that really quickly.
Yeah, and I think that's the thing that people need to realize is that um, when you force companies to raise wages, you force them to make financial decisions.
Right.
So you can talk about how much the CEO made, but the CEO makes that much money because he's worth that much to the company itself because of the decisions he's made. And this was his decision, right? He looked at it going, look, we're going to be losing money delivering pizzas with this minimum wage, so we've got to figure something else out. In the meantime, we can't afford to pay them this. We've got to cut them.
Right. And that's why you have a Domino's, Pizza Hut. A lot of people don't realize a lot of companies they fail. They don't exist anymore because they weren't able to make those financial decisions and basically lever themselves to where they didn't fail. And so if the government keeps doing that, they're going to just adjust. They're just going to adjust. Now, if you own the business, you turn it the other way, you own a
Right.
business. Now you're making no profit. You're upset at the government for raising wages, right? Oh, well,
Yeah.
they're
Yeah.
rich
Yeah.
already. And then people argue, well, but they already are making money. A lot of these businesses aren't really making money. They're borrowing a lot of debt to keep the wheel turning. Number one. Number two, if they did make money, well, yeah, they started a company. They took all the risk where you don't see the other 90% who failed and had to start over again, right? So they're taking massive risk. And they have a family, and they're also producing jobs for other people to some degree. So I say, hey, if you deliver, 100 pizzas in the shortest time, maybe you get a bonus, right? If you deliver two because you're lazy, you don't get nothing. That's what I say. But we'll see if that system ever comes. All right. Now we'll go ahead and shift to the economic data. This was, we had a lot of data. Let's go ahead and look at the GDP nowcast. So this week, Atlanta Fed GDP forecast actually was raised. So it looks like fourth, and this is for fourth quarter. So it looks like fourth, or no, this is now. No, this is nowcast. So it looks like the GDP is starting to raise a little bit. We had the ISM. Let's see if I missed anything. We had ISM services. I call this pre-expansion. I think we're in pre-expansion. It sounds like the housing market is flat, but for me, the way I measure things as far as economic momentum, if we keep this up, the housing market sort of looks like the business cycle where it's a little more laggy, but you're starting to see it bottom out and maybe start to uptick a little bit.
Yep.
So we have ISM picking up. Now here are some of the details. I highlighted just new orders, future growth, production, employment, prices. Well, prices all the way to the right are falling, right? For production, that's great for the economy. Employment is picking up. This was really interesting. Employment's picking up for the manufacturing sector. I think the recession in the manufacturing is no longer there, and production's picking up, so that tells you you're producing more, you can grow without, prices going up. That's positive. And then new orders are flat, obviously, because demand is down. Now counter to that, we had services today. Let me see. Did I load that one up? I think I loaded it up. Did I not load that up? Well, we had services today. I can switch over to. Oh yeah, I have it on here. Let me switch this over. So on the opposing side, I should have just made one chart. On the opposing side, we had ISM services actually contracted. Oh, you know what? That's what I was going to do. I was just going to go to this. Let's just go to the business cycle itself. Let's just go to the straight data. So ISM services, service economy, right? Contracted a little bit. Let's go to a longer term chart. It's falling. Um, it's still in expansion territory, but the interesting thing is we're seeing manufacturing start to pick up a little bit, start to bottom out, and possibly services are rolling over. What do you think is happening? We talked about this a couple months ago too. Remember, we're like, we might see a switch here. It's starting to happen a little bit. So, what do you think is going on as far as economic activity and momentum for services?
Well, I mean, you got to remember, we just talked about it. There's issues with rising wage pressures for services. So you're looking at that industry itself, looking at it from a perspective of, are we going to be able to afford this? Is this going to be something we need to expand on, or is it something we need to contract on? And that's just because of the economics of having to increase wages. So I think that's where the pressure for the service industry is coming from.
Okay, and I believe that oh shoot, I believe you called this one also last time we talked last month. Average hourly earnings. You said, hey, they might tick up. I was like, nah, I think we go to 3.9. So we did tick up. And you want to go ahead and give why you said you might see that happen really quick?
Yeah, I mean, again, it just goes back to the wage pressures. So with a lot of the demand from, um, the average U.S. household wanting more money for what they do, you're seeing businesses. You've got the unions renegotiating higher pay. You've got the government increasing minimum wage. And then you've got people who are just demanding more money for the job that they're doing because they need to afford to live. So I think the hourly earnings pressure is only rising. We haven't seen that kind of top yet, I don't think. So I think moving forward, we see that rise a little bit more. But where does it stop? In my opinion, it's going to stop when businesses decide, look, we're not raising wages, we're not hiring more people, we're going to start cutting people because this is happening. So I think that's another reason why you're seeing the Fed pivot and decide, hey, maybe we should cut rates a little bit because we need to make it a little less expensive for those corporations, so that they can maybe start paying their employees a little bit better, or bring on new employees at a cheaper cost, one of the two. And obviously, with immigration, you're going to see those that can provide in that labor force come into the market at a lower cost for those for those companies. So you may see that kind of offset where the wage pressure is coming from the people that are already there. But again, minimum wage and the union talks are going to continue to pressure wages higher. But where does that kind of level out? Again, immigration, labor force. And then when businesses decide, look, we're not expanding, we're not paying anymore because we can't afford it, there's a lot to go there. But I still think wage pressures are going to continue to rise.
Okay. Now, I would say as long as inflation continues to fall in the energy front, higher, I think spending just continues. I think we're okay. That's not too bad. Do we want to see that? No. And I was going to ask you, do you think that's enough to get the Fed to flip or just hold? Because some people are going to say, "Oh my God, it's going up. They're going to start hiking again." Or do they just pause longer? Or do they not? Is that not enough data for them to not
That's
cut?
not enough for them to really worry about inflation, because obviously we've seen inflation start to come down, and a lot of that is due to the energy. I think I saw some crazy statistic. We're producing more oil per day, barrels per oil per day, than Saudi Arabia or Russia ever did. So I mean, the U.S. is pumping out energy like crazy. So I think we're going to continue to see energy prices stay low, and maybe even go a little bit lower.
Another misconception. Oh my bad. I didn't mean to throw you over there, Josh. No, I'm just playing.
Oh, good,
Uh,
brother.
another misconception is people still are being told on, I don't know, whatever media it is, that the US used to be the number one energy producer. And it's like, no, we're actually record high pumping oil. That's just false. We're pumping oil like crazy. That's why oil prices are not going up. And we're probably going to keep doing it for now because it's all about saving
Well,
the
and
economy.
it's going to happen until OPEC decides to flood the market.
Right.
And that's the next shoe to drop, right? OPEC's going to decide, look, we're done playing this game. We're not making as much money as we used to because of the cost, or the price, and we're cutting, production. Instead, we're going to increase production, flood the market with oil, drop the price, and get the U.S. market to capitulate.
Right, 100%. Yeah, I agree. We've been talking about this for a while too. Is the OPEC flooding the market just to they're tired of losing money. They're tired of losing market share to all these other small companies. Russia selling underneath. Nobody's listening. I wonder if OPEC even lasts any over the next 10 years. I wonder if they really do last because oil is no longer the dominant force it was for the global economy.
You got to wonder, right? How much does OPEC really have the power to affect markets, right? They used to be the global place where we got all of our oil, but as the U.S. has shown, they have the ability to outproduce, and put up some big numbers. So, do we really need OPEC?
Right. Jessica says thanks to fracking. 2015, I believe.
Yeah, I don't think they do much fracking anymore.
Okay. What was I gonna say? Also, how was the other part of it? Oh, I also learned that Venezuela actually has the biggest oil reserves where they're at. They just can't access them because, obviously
The
their
terrain
yeah, the
and the
terrain. So
economy. Yep.
so
But
I had to
yeah, they're huge, and I think the conflict with them and their neighbor has the world a little bit scared. Just because if they do go to war with, is it Guyana? I think is what it is, to take over that land that they want to take over, which I believe has a large base of natural goods. That's what they want it for.
mhm.
They could. Honestly, I think Venezuela is making a play to try to get into the energy market and start to turn that economy around with force. If they're able to do that, then I think we see a huge uptick in production from oil and a lot of natural resources out of Venezuela.
I agree 100%. I think these high oil prices are pretty much done. Maybe next couple years we're back down to $60 a barrel. Maybe by the end of this year, $60 barrel. And I think also the US is incentivized to like make a deal with Venezuela. Let's get that oil out here. Let's lower the cost of energy.
They've already cut a lot of the embargoes and stuff that they had put in place to keep Venezuela out of the market.
Right, 100%. So we'll keep that in mind also. You hear the opposite, but it's all about the if you don't have a strong economy, if prices are not stable, you can't really do much. Politics always depend on your economy. All right. So other chart, employment here. This was a big surprise today. Well, unemployment at this point, I think we both agree it ticks up going into February because it's going to look back to January. So I think this is the high print or the quality print, and then we start to tick up to 4.1%. I think that's what the Fed has. Um, Today, jobs growth still picking up. Uh, this might be the end, and seasonal jobs pretty much over. Yeah, there's still pretty strong workforce when it comes to gig work. I believe. I think it's going to be stronger than expected as it's been. But what do you think? Um, do you think the payrolls data has peaked from here and that unemployment has bottomed out and goes back up from here? Because what is it? We're looking at December, so January, February.
Yeah, I still think unemployment's going to start ticking up. I hope it doesn't, but I think that's well, with the Fed's flip on cutting rates, I think unemployment may not get as high as I had originally thought, because they are going to make things a little bit more affordable for those corporations to be able to keep the employment up, keep the unemployment numbers down. So I think that's a big kind of wild card there. If they follow through with it, we do see the rate cuts. I see unemployment maybe getting up into the fours, but not up into the fives like I had originally thought.
Okay, yeah, that makes sense. I was surprised too by the rate cuts in March. I was surprised that too. Now, what also comes, we were talking about this earlier, shadow liquidity has been
Ends in March.
helping, ends in March. So no more Fed liquidity. That aligns right up with the rate cut projections that everybody's expecting. So, yeah, we think that's going to happen. We're definitely going to see rate cuts. Now, some people are saying, I read on Twitter, some economists, some macro crypto guys are saying that Janet Yellen's going to say, no, we will not create another bank term funding program. But as soon as we see the risks, boom, here we go. He called it, what do you say? He was using her as like the teacher who says, no, we're not doing that. And then turns into grandma. Yeah, we're going to give you the cookies.
Good guy,
This,
bad guy. Good cop,
yeah.
bad cop. Yep.
Right. So, and she said today too, "Oh, we're certainly having a soft landing." I think she said that this morning. So that'll be interesting. What do we? Oh yeah, that was average hourly earnings. We already saw that. So yeah, that was most of the data, I think. And then going back, ISM was definitely picking up. So I think we have most. Oh, GDP. Okay, GDP finishes the year pretty strong. And let me make sure I'm not missing anything. ISM employment. So key thing here, service employment fell to contraction. It hasn't done that yet. We're in I think we're at 43 now for services. Let's see. We're at 43 for ISM services employment. That was a big drop. This is forward-looking growth. So yeah, services are still positive, but we might see services dip negative over the next couple months while manufacturing still is negative. So this might be your recession if you get it. A small little recession, maybe nothing too crazy, I think, but employment for manufacturing picking up. So that's probably the big change in economic momentum. Still in a rolling recession, it looks like we're going to be seeing going forward. A lot of jobs still there, and yeah. So let's go ahead and switch over to the geopolitical risks. Um, so what are some of the tensions? What do you see? Because everybody's talking about the geopolitical tensions now picking up. What is your outlook on that?
All right. So, well, you've got the warning to the Houthis in Yemen. If they continue to fire missiles at ships in the Red Sea and try to take over some of the cargo ships that are moving through the Red Sea, the U.S., Britain, and a couple other countries warned them, said, "Hey, if you keep this up, we're gonna come after you." That could escalate the tensions because the Houthis are in Yemen, which is a total another country besides Israel and um, Gaza. So I think that could increase tensions. I think I was listening in on the Russia-Ukraine conflict, which doesn't get talked about much anymore. But Russia's pretty much taken control of most of the major parts of Ukraine that they wanted to. They've lost something like 300,000 troops, but we knew that going into this. Russia has the population to outlast Ukraine. And I don't think the artillery and the military support that we've given the Ukraine is enough to outlast the just the sheer numbers of Russia. So still, that conflict's going to continue to rage on. and I don't think Ukraine ends up on the winning side of that. Um, then you've got the issue, which is the Venezuela Guyana possible conflict. So there's still quite a bit of global conflicts that could play a role in the economy. You know, whether it forces us into more military spending, or draws us into a conflict globally. So I think there's still a lot of issues that are going on that could have either a positive or negative impact on the U.S. economy.
Okay. Um, yeah,
And
those
you've
are
got an election year.
and you got an elect. Oh, you know what else I saw too? So you put all that together because also what? Go ahead and tell them about North Korea because they're saying North
Ah,
Korea.
yeah. So it's pretty misleading, right? So from what I understand, they were North Korean rockets that were fired, but they weren't from North Korea. They were just rockets that were in with the Houthis in Gaza. They had the artillery from North Korea, and that's what was fired. It wasn't actually North Korea firing missiles um, from North Korea or a base for North Korea.
So basically, a bunch of proxy wars.
Yep.
Sounds like a lot of proxy wars. So Mosin says, imagine North Korea attacks South, China attacks Taiwan. U.S. really has some bad cards right now. I wouldn't buy into that so much because nobody's going to make any moves until after there's an election. I don't right now, anyways. And also, 80% of the world is this was on something I was reading, I think last week. I posted on Twitter. 80% of the world is going to see elections in 2024 and 2025. This is the largest elections for the world in history. So
Some major turnover, possibly.
major turnovers. Is that bearish or bullish? Shoot, I don't know. I think it's bullish. I think it's bullish because I think there's going to be a lot of concessions to get elected here
Yeah,
going
and I
forward.
think as far as the China and North Korea thing, China can't afford to invade Taiwan. They need the U.S. more than they need the semiconductors in Taiwan. They've already kind of shown that with the visit to California. And North Korea is just a dog with a lot of bark, but not a lot of bite.
Yeah, I agree. Um, have you ever seen the movie? What is that movie? I watched the movie. I think it was based off North Korea. There's some really good Korean movies, man. Some really they would never show them in the U.S. Really good Korean movies. Have you ever seen? It's called Old Boy. You ever heard of that?
No, no.
Ooh, can't even talk about it on here, but it's a really good movie.
Mm.
And I think people need to look out of it. The U.S. just never shows. We never have really good movies that actually take you out of the US. They're usually just US based. They're
It's
very
a lot of propaganda.
a lot of propaganda. So you look from another perspective and it makes you think twice. But yeah, either way, it looks like things are starting to settle down at least in the economy as diving any deeper. Oil's still pretty low. I think we see oil going lower from here. Maybe not like immediately, but I think oil's pretty much done. We have a lot of supply, economic activity, and tell me what you think too. Economic activity seems like it's starting to bottom out. Manufacturing's picking up. I think we start expanding, and I'm going to call this April, May. I think April, May, we start to expand because the Inflation Reduction Act we're still getting more concessions there. The infrastructure bill and the CHIPS Act. I think there was some more stuff on the CHIPS Act earlier. So tech, in my view, is starting to pick up. And then obviously, like you said, in the housing market, we're starting to see more activity, but not necessarily prices moving up. More so, more activity. People are refining. They're starting to do a lot of refi. We're starting to see the refis go up. And I didn't really know this was a thing, but I guess or I was going to ask you, is a lot of people their housing their mortgage, I guess, what would you call it, their mortgage, not income, but their mortgage asset has gone up significantly over the past 4 years. So as much as we talk about, and this goes to the consumer is going to slow down and roll over, maybe, but a lot of those mortgages went up for those consumers, and now I hear they're, and you probably know this firsthand, they're is it that they refi? How do they take out, is it a home equity line of
So
credit?
obviously, with price growth, people's homes have gone up in value. They've appreciated. That's basically equity in their home. That equity can't be touched unless they either refinance or take out a home equity line of credit. Both of them are refinancing, right? So a home equity line of credit is basically a second mortgage behind your first. Um, and you can tap into that equity that you've earned. And that's what we're seeing an uptick in. because again, a lot of people have several clients with 2% interest rates on their first mortgage. There's no financial sense to touch that. So what they're opting to do is take the home equity line of credit, which is basically like a credit card against your home equity. You can tap into up to 95% of the value of the home. Um, in combination with the first mortgage, it goes into second position. You have a 10-year draw period, so you can draw on that line of credit. You don't have to take all the money out at once. You can use it like a credit card. You have 10 years to use it. In the first 10 years, it's interest only. Once that interest only draw period's over, you have 20 years to pay it back. It becomes amortized. The interest rate's tied to the Fed funds rate. So as we have all learned, the Fed's done hiking and we may see them cut rates. So those interest rates have peaked on those home equity lines of credit, and we may see those interest rates come down. And you can take advantage of that by getting the home equity line of credit now, not using it until you see the rate cuts, using it to pay off higher interest debt, upgrade the house, purchase another property. That's kind of what people use those for. And so we're seeing a huge uptick in those home equity lines of credit.
Okay, so my brother was actually we are talking about this when he was here to visit. That once you take that home equity line of credit out, you don't necessarily need to start paying interest on it until you
Right. So until
swipe the card.
you only pay on the amount that you've drawn. So if you don't draw anything when you get that line of credit, you don't have any payments.
Hmm.
It's only until you take money out of the line of credit that you start paying the interest on it. You can pay principal and interest, but your minimum payment is the interest only. And you only pay interest on the amount that you've pulled out. It's literally just like a credit card, but
So
about a half the interest rate.
okay, so then a lot of people can financially engineer their debt by taking out that credit, paying off 20 whatever percent credit card debt, and now they're paying, less on that. And so does that play into for you like, okay, this economy is going to be stronger than previously thought because there's actually more tools. There's a lot more tools. The Fed is starting to flip now. And because I know we talked about this before. I mean, you said, hey, people are going to start paying off their credit debt that way. And I guess we're starting to see that. And I didn't even know that was a thing. Like to me, I hear it, but I don't really understand how it works. Now I'm like,
That's
shoot,
one of the advantages of home ownership, right?
right, right. One of the advantages. I think I'm going to do that, Josh. So I might call you up one of these days. I might just buy a home in cash and then just go ahead and take that out when the crypto market crashes and just buy some crypto and then, flip it. We'll see. We'll see how that plays out. But yeah, all right. So give us a review then of how you see the housing market going from here. I know a lot of people still confused. They hear this or that based off the Fed's maybe starting to cut. Let's say base case, the Fed cuts 3 times March, I think May, whatever. By summer they cut 3 times. Where do you see? Is it a good time to start looking at least and scouting a good deal on a home?
Yeah, I mean, so here's the deal. Like I said, we're seeing more property owners willing to sell their house now because interest rates have come down. If they go down any lower, we're going to see even more. So one of the things that we try to tell people on social media is if you're planning to buy a house, it's better to start early. Because you need to know where your credit is. You need to know how to get your credit to the best possible position so that when you're ready, you're able to buy and you're getting the best possible deal. So credit planning, something that we do, and it's something very important when you're buying a house. You don't want to wait until when you're absolutely ready to buy a house to get your credit run because there may be some sort of surprise. Also, you're probably looking at a credit score that isn't your actual mortgage credit score. You're looking at your FICO 8, so you really probably don't know what your credit score is. You just know what your credit card FICO score is, which doesn't have any impact on your mortgage FICO scores.
Can you explain
And
that really quick? Can you
yeah, yeah,
explain
yeah.
that? 'Cause there's like
So,
10 different credit. There's like
oh,
10
dude, I think there's like 12 in each
wow.
bureau.
Okay.
So you have multitudes of FICO scores. FICO scores, it's like FICO 8, FICO 3, FICO 2, FICO 4, FICO 11, FICO 10, FICO 12. They all have some sort of, I guess, role in credit in the grand scheme of things. Mortgage lenders look at your FICO 2, 3, and 4. They don't look at your FICO 8. You also have the Vantage score. So, God, was it like 10 years ago? Um, Fannie Mae, Freddie Mac, and the government said, "Hey, we need to look at possibly doing some sort of different scoring model." It's come to our attention that maybe the FICO score model that we currently use is antiquated and isn't good for the consumer. So they basically said, "Hey, let's come up with some new scoring models. Let's see if there's a better way to do this." So Experian, Equifax, and TransUnion, who have cornered the market on the FICO score model and are the conglomerate that does everything as far as credit is concerned, said, look, we're not going to lose all that money that we make charging for credit reports and the FICO scores. So they came up together with what's called the Vantage score. So a lot of what you see on your apps are your Vantage score, which is the scoring model that Equifax, Experian, and TransUnion made up and created to replace the FICO score model. And so it's not currently in use by anybody, but there's actually, it was supposed to happen later, like late last year. They were supposed to roll over from the FICO scoring model to the Vantage score model and a whole different scoring model, but they chose to delay that. So it's not been done. So we still use the FICO 2, 3, and 4, but they're all different, right? So there's the FICO 8, which is the consumer one that you get on your Experian.com. The only place you can actually see your FICO scores for a mortgage is through myfico.com. You have to pay, I think, like $30 for the FICO 2, 3, and 4, and they'll give you all the different scoring models. They tell you what they're used for. Otherwise, you've got to go to a mortgage lender to get your credit pulled. But obviously, if you're not ready to buy right now, you don't want to go to a mortgage lender and have them do a hard inquiry because you don't want inquiries on your credit report. So you want to make sure you're talking to a mortgage lender that will do a soft credit pull. The soft credit pull doesn't show up on your credit report. It doesn't show up as an inquiry, but it does give the lender your FICO 2, 3, and 4. And they can go over those with you and show you kind of what you can do to improve your credit scores between now and when you're ready to buy a house. So planning is the most important part if you want to become a homeowner. So better to start now, know where your credit is, know what you need to do on your credit, but also create some sort of budget so that you can plan when you do buy a house. Hey, I'm comfortable paying $2,500 a month, but I'm currently paying $1,500 in rent. I'm going to budget for that $2,500 now and see what it does to me financially to make sure that that's what I'm comfortable with, so that when you do buy the house and pay $2,500 a month, it's not strapping you. You don't want to be house poor.
Okay. You guys heard that. Tricks from Josh. He'll be on here. I'll have his stuff in the description. Get your questions out now if you do have any questions. We're pretty much done here. We got one question here from Mosine. How can I buy a home without paying interest besides paying full cash?
Can't. Anytime you're borrowing money, you're going to pay interest. That is how borrowing money works. So lenders are going to lend you money based on an interest rate. So unfortunately, if you're buying a house and you don't want to pay interest, you've got to pay cash.
And also there's is there what do they call them, shark lenders? What is your view on the shark lenders? Because when you have bank credits, you have
You're talking about
credit.
hard money lenders?
Oh, is that what it is? Hard money
Yeah.
lenders. Yeah, yeah.
So those are the guys that will lend money to people who can't qualify for the conventional type mortgages. Usually, you're going to be paying double-digit interest rates. You're going to be paying 3 or 4 points up front. So it's a lot more expensive, a lot more costly, and you're going to have a larger down payment than you would if you got a conventional mortgage. So hard money lenders are strictly for if you can't qualify for a conventional mortgage, because it's going to be a lot less expensive getting some sort of conventional style mortgage.
Okay. And how long is the average process for somebody starting, I guess from the time they call up, who do they call? They call up like a banker to find out, what their rate would be.
They would
Can you
call
hear
me.
me?
Yeah,
Oh,
yeah,
they'll
yeah.
call you.
No, no,
Oh,
no, 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 no. So if you're thinking about buying a house, you would contact me.
okay.
We would do the application. We'd do the soft credit pull. We'd collect all your income and asset documentation, basically calculate, qualify you. That takes me about 24 hours to get through all that with somebody. Once we've done that, you can either choose to move forward and start shopping for a house being pre-approved, or we create a plan for you for whatever your timeline is to purchase a house, so that you can maximize your credit score, save some money, do whatever you need to do to be able to be in the best possible position to buy a house. But typically, it takes about 24 hours to get pre approved. And then the process itself, once you've started shopping for a house really depends on how long it takes you to get into contract. Once you're in contract, most contracts are 30 days, unless you're building new construction or unless you're buying new construction. New construction can be anywhere from 1 month to a year. I think I have one of my clients is in contract to build buy a new construction, and it's a 2 year contract because it's going to take them 2 years to get to building their house.
Okay. Hmm. All right. Any other questions, guys? I guess he said, or she, I don't know who it is. I guess I'll just wait for Jesus to return then. Yeah. Hey, look, get a hold of Josh. I'll have his info if you're on TikTok. Go to my followers. You'll see him. Josh Dobson, mortgage dad of
At
three, is
mortgage
actually
data three. At mortgage data three.
at mortgage dad of three. If you're on TikTok, just go to my followers. You'll see him on there. If you're on YouTube, go to the description. I'll have the links on there. I've had we've done previous streams with all his info in there. Also, if you don't see it in there right now, because I was lazy and I didn't put it in there right now. So, anyways, if you guys don't have any other questions, thank you, Josh, for giving us the wisdom. We'll meet back up. We'll do this again when things start turning. And I appreciate you coming on.
Hey, I always love it, man. I appreciate you.
Love it. All right, guys. We will do a quick overview for you stock guys. We'll do a quick overview on what happened today in the stock market. I'll come out probably tomorrow. I'm thinking we'll do a stream with a little more info. Okay, we'll do a little more info, but hey, we just want to keep up with the housing market, see some stuff from an expert. That is a mortgage expert. I'll probably be calling Josh. So let's go. Oh no, this isn't the chart. Well, that is S&P right there. This is S&P. Actually, let me make this a little bigger. I never pull this chart. That's S&P and Qs today. Definitely try to get above that level. We talked about this yesterday. We could not get above that level. So let me pull up the real chart. That's not the chart we wanted to see. Oh, there it is. All right. We'll do a quick look on this. And yeah, we're not really doing tickers today. We're not doing tickers today. I just want to do a quick overview. I'm still watching Tesla. Tesla is coming down still. I think we possibly hit 225, 230 based off the weakness. There's your support that I'm looking at, 225. Here, let me flip the chart. We'll go through this. We'll go through this rather quickly. Just want to do overview if you're still on here. All right. So here's what we're looking at. There we go. Here's what we're looking at for S&P 500. I think we still come down. You can see we try to make a couple up moves, but there's a lot of capitulation, right? This is the inflation report. I have this marked because I believe that we're either going to bottom or turn back up around this report. I think the report's going to be good. I think it'll be pretty good, but I think we're just going to keep trickling down. Typically, you don't wait till the report unless something bad happens. You never know. But I think we're going to stair step our way down. Maybe we get here quicker. We don't have to come to this support. We could, bounce here. I'm not sure exactly where we'll bounce, but this is just a good marker, a good model marker to show, okay, somewhere around this data print, the market should start to reverse a little bit. And then we head into earnings season. And I think there's a couple pivots. The data should be softening, so we could come back to the highs, sell off again, and move sideways for a while. That's a real possibility. We're moving sideways with individual stocks moving up who have a catalyst behind them. But for now, here's what we're looking at intraday. You can see the S&P is struggling. I think we're going to close in about 15 minutes. Should be closing. So we have sort of that doji candle. This, you could say this is a reversal candle. It's pretty much there. Buyers or sellers are meeting in the middle. Got a little doji. Let's go to the 30-minute chart. All right. So this was the level of resistance that we drew out over the past couple days. We couldn't get a pass. I didn't think we would. I said we either gap up or gap down. I thought we would gap up a little more, but we did run up strong. Boom. There's your short. We talked about this yesterday. Short against that level. I don't think the market's ready to rip yet. So if you did short, congratulations. But it didn't make a new low yet. We're not making any new lows. So that was your level. We have some support here in pre-market. And really, here's the key. What we're seeing here, this was the Fed meeting. This was the Fed meeting, right? So what did we do? We exploded when Powell got dovish and said, "Hey, we're actually going to start cutting rates. We're projected to cut rates 3 times going into 2024." The market loved it. We had that big crash on no volume, moved back up, sold off again, and I was like, this looks pretty bearish. We're over leveraged. We should be coming down at this point. And now I see your comment. What up, Dimaj? And now we are coming back down to retest that level. So I would be patient here. I don't really see much. I'd be patient and wait till we get not wait. I mean, if you're day trading again, doesn't matter, but at least be a little more patient. There's no clarity on where the market's going. If we retest this level again and fail, it's pretty clear you want to short against that and go lower. But if we do zoom out, we are looking at maybe a huge range. Look at that candle, man. Really try. Are we flipping? Yeah, so we're really trying to flip there. Why does that look so different than the other one? Oh, I see a lot of volatility at the end of the day. We're coming back up, going back down. Are these both the same chart? Oh, that's a 4-hour. Okay, that's no wonder 4-hour chart. So daily chart, all these candles are signaling weakness, right? You try to come up, boom, got slammed, come up, slammed, slam. Too much weakness here. I think maybe we do slip beneath this and then, we turn up, but it's pretty weak. I think we're just going to head into that inflation report. Today we got basically we had strong employment data, but I think the market is sniffing out this is the end of the strong data. That's what I believe. The market is sniffing that out. Remember, weakness is the next risk. It's not inflation. Okay, yeah, there's some shipping stuff going on geopolitically. Wages went up a little bit, but nothing significant. The trend is definitely lower. And when it comes to the macro forces, you have the dollar pick up. Are we on the daily? Yes, we are on the daily. So you have the dollar pick up, right? Remember, I said, hey, the dollar should be picking up here. Our support, it's on this chart. Let's go to our resistance for the dollar. Our resistance level for the dollar. We came into that, we got rejected, right? But now we're climbing right back up, and you're seeing momentum start to pick up. Now this is the signal. This is why I still think we have more downside from the high, 3 to 5%. I think S&P goes to 460. We'll see. I almost took a position today because I was like, oh, it looks like we're going to reverse, but I'm like, something doesn't feel right. I really think it's going to come down to getting closer to next Thursday. So you have the reverse head and shoulders on the dollar. What does this mean? This means the dollar is more likely to break out and go to this next level. You can see all this demand. No, I'm just kidding. All this supply. And I think we're going to break out to this level. So if we go to this level, S&P is most likely, right, more than likely going to fall. And we are also seeing rates rise again. Where are we at with rates? 10-year rates, where you at? Always use the benchmark rate. We're back to 4%, climbing sharply. That means bonds are declining. Where is that sell-off period? It's somewhere up here. Where rates are headed to 5.25 possibly. So I still think we have more weakness looking at the macro forces and just understanding the macro. This has all been about macro. Dimaj, I'm reading that Amazon dominated over 25 to 30% of total online sales in December. Yeah, Amazon crushed it. So that's a good question there, or a good comment there, because I think we're still going to see outperformance in earnings season by specific stocks, maybe small caps and part of the probably Nvidia, probably Amazon are going to have very strong sales. A lot of companies are going to be weak because the fourth quarter wasn't as strong for them, but then you're going to have some companies that are very strong. So I think S&P bounces in during inflation. Okay, during the inflation print on Thursday, I think we're going to bounce, and I think we're going to come right back to the highs. Right now, this is just a model. Who knows? I think we come down here, we bounce, we go to the highs. Earnings season, I think we're not going to make new highs unless earnings are really good. Maybe some stocks make new highs. Maybe the Qs make new highs, but I think we're going to be in this range until we get more clarity on if the Fed is for sure going to cut, and some more clarity about exactly how slow is the economy decelerating in Q1, right? What do I mean? Well, all the data we got today, I know we're in January, but this is a reflection of December. This is a reflection of holiday spending of the Santa Claus rally. We're seeing the after effects of the Santa Claus rally. The forward-looking indicators for services are falling. Employment is down, new orders are down. ISM new orders are still in contraction. So manufacturing and services, or economic momentum, is still in contraction. It's not very weak, but it's still weak. And I think growth is a concern. So watch for the dollar to move up, rates to move up, and the stock market to fall, and then have that rebound at some point going into earnings and probably move sideways again until we get more clarity on the Fed. That has been the story. The story has been, let's see if I think I redid the chart here. I'm going to show you that chart. I made it a little more simple. Yesterday it was I made it way too complicated, but here's the chart. It's on my Twitter. I'm going to pull that up before we exit here. No, dope. Oh, this ain't mine. Here we go. Here we go. Getting closer. Here it is. So I redid this chart, zoom in there. So basically drop rally, right? This is what it is. Inflation dropped significantly, rally. Inflation, and here's your rally. Inflation dropped significantly, we rally. Um, we had inflation go up, the market sold off. Okay. Let me simplify it. Significant drops in CPI sparked market rally. So let me restart. I'm going kind of quick here. Sorry. Inflation 4.9 to 4.1. That was the drop in inflation, significant. Market rallies following that print. Okay, it drops again, drop, rally, and the market rallies again. I think it's all about earnings and inflation, right? It's all about earnings. That's something you can control. Inflation, you can't control it as much. Not that you can control earnings, but you can engineer better financials for certain companies. Maybe biotech, healthcare starts to outperform a little bit. Industrials are set to outperform. Anyways, back to it. Drop rally, right? So what did we get here? 3.7 to 3.2. Drop in inflation, market rallies, right? There was some other stuff going on. And then again, going into this inflation report, inflation dropped, not big, but everybody thought it was going to be a reacceleration and it didn't. So that was significant. Boom, we rally again. So we're now in a drop. I think we drop into that 200 daily moving average. Oh, sorry, you guys can't see it on TikTok, but it's on the YouTube. So we drop here, and January 11th, that is the day. January 11th is the day. Here, I'll pull that over for TikTok. Sorry, got too into it. Drop rally, right? Just look at the chart. Drop rally, drop rally. Got drop rally, drop rally. So I don't know what it's going to be. I think it's still weak. We might get to 2.9. We might get to 3.9 in core. If that's the case, then you're seeing inflation drop significantly. Boom, we get a rally. But do we just break to all-time highs? I don't know, because growth is the concern. Growth is now starting to become the concern. So I'm not sure if we do have a break of all-time highs. Either way, this was the treachery, right? Q1, Q2, that's where it gets a little treacherous, and where individual stocks are going to perform, but the overall market might be kind of flat. Bonds probably outperform again. So this is where I think you see TLT rolling over. It needs to slow down. It was up too much, but could come down here, fill this gap, which means rates are going to rise. We're going to see 10 years rate. That's what the Fed wants to see, to make sure, okay, financial conditions are tightening for us, not against us. So once we get those conditions tightened, then I think inflation's down, rates are down. The market can now say, okay, how good were earnings? What is the projection for Q2? Remember, Q2 earnings are set to rise. Q1 flat, Q2 are set to rise. So I think we could see a sideways action in the S&P, and then somewhere between March and April, I know it's a lot of data, somewhere between March, April, I think economic activity starts to rise enough and inflation becomes more apparent that it's falling. The Fed is now going to be cutting at that point, maybe for a negative reason or not. And I think we move sideways, and then May, April, boom, we break out. S&P, TLT should start rising again at some point. I'm not too worried about inflation, because when I take a look here at oil prices, right, we're producing a lot of oil. Unless the risks rise, the trend is lower. Maybe it bottoms out at 70, but you see those gasoline prices are not rising again. Just watch the chart of oil. So we're looking straight there. Russell, love muscle, not strong. Oh, what up? Big man's coming. Waiting for us to get to the charts, huh? Okay. So yeah, IWM also. Small caps. I think small caps are going to have a nice rally once they bottom out. So they are coming in right here. I think that's what we're looking at. VIX still struggling. We haven't looked at the VIX for a while. It looks like it's starting to climb. What you want to do is look at the volatility of VIX. Is it climbing? Yes, it is. Is it significant? Huh, nah, it's not significant. The trend is still lower. Still got a lower volatility of VIX, so that should roll over also. But you got geopolitical risks. You have rates in the dollar moving up a little bit. How about credit risk? Nah, there's no credit risk. So this is why I'm still bullish. A lot of people need to lever back into the market once inflation is clear, once the Fed cuts. So now we're still on the Fed and we're still on inflation. We're still looking at those two factors. Use the technicals to guide yourself. Technicals don't tell you what's going to happen. Macro doesn't either, but you got to put everything together, correlate it. Fundamentals are still strong, but we are set to decelerate a bit. I think that's all we have. Let's see. Tesla, if you want to know what I'm thinking, I'm keeping my eye here. I think I'm gonna start grabbing some Tesla. Um, Man, that's a 1, 2, 3, 4, 5, 6, almost 7 days in a row of selling. I'm hoping we get one more drop and we come back to this candle, right? To this capitulation candle where there's some stronger buyers. You can see there's consistently stronger buyers down here. So I want to see it get into this red area between 225 and 230. That's what I want to see. 225, 230. And I'm gonna start grabbing some longer calls. Do I think it just rallies to the highs? Maybe not, because we have earnings, but I think we're gonna get a push higher. We're very oversold, and then decide, okay, how were earnings? Can we break out of the monster trend? Can we finally break out of the monster trend, head to 300, break 300, go to all-time highs? We have some time to go. You got to stay patient there. Either way, buy that boy all the way down. Huh. Would you say, Mosine, for first green day of 2024? Tessa buy it down the dark Heim. Yep. Right. So I'll get some videos. We had some Tom Lee stuff. So stay tuned. Look at your shorts for YouTube. Watch your shorts for Instagram and Instagram and TikTok. I'm gonna go do some shorts right now. Nothing off this. We're just getting an update on the mortgage market and some of the macro. But Tom Lee spoke today. We had a couple good speakers. So we'll see what they're saying. What are they looking at? Tom Lee's been calling this market the entire time, and I want to see what he has to say, and I will push that out there. Highway Electric. So yeah, that's it. We're done here. All right. Watch out for your shorts. I'll do a stream likely tomorrow or Sunday to find out where we at in the cycle. Go over this again. Maybe look at some individual stocks and see what's going on here. Other than that, you guys have a great Friday. Stay safe. Okay. Lift weights. Eat protein. Good protein. Don't eat processed foods. Stay healthy. Learn something new. Teach somebody something that you learned. Get better. Improve. Stay blessed. And I'll catch you next time.